Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis, investment insights to help boost your trading potential. Coming up, we got markets near record highs, but investors cannot shake their worries. We're going to speak with Belpointe's chief strategist in just a couple minutes' time. He says we're wired to worry even in a rally. Plus, we're going to hear why he thinks the AI boom is the real deal and not 1999 all over again. Then in today's technical take, we're taking a closer look at the buy now, pay later boom. That's all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. Half an hour of trading under our belts in this day, and we're to the downside. I want to start with the S&P 500. You can see a pullback is across the major indices. In the absence of official government data, we look to the private sector. Challenger and Gray today telling us there's been a surge in layoffs in the United States. Job cuts for October totaling more than 153,000. That is a 183% surge from just the level we saw in September, the highest level for any October in this read since 2003. Tech companies have been shedding jobs. Of course, we're all trying to figure out what the Fed is up to next. Jobs numbers are pretty important. We don't get the official ones, so we look to ones like these. Let's check in on the heat map and see where the weakness is right now. Apart from Google showing just some modest upside, we got some downdraft in the big tech names, whether it's Nvidia, Microsoft, or Broadcom, and Oracle, and Apple, just Amazon. Take your pick. Qualcomm, I want to dig deeper into that one, though. Expects it's going to lose Apple as a customer for its modem business in the coming years. That bit of information seems to be overshadowing their fourth quarter earnings revenue beat and a strong current quarter forecast as well. So a bit of push and pull on that name. I want to take a look at Snap. This stock actually popping today. You can see right out of the gates and in the pre-market how it was performing. It unveiled a $500 million buyback program and issued some pretty strong revenue guidance. Now, additionally, there's an AI story here. Perplexity AI apparently going to pay Snap $400 million to integrate its search capabilities into that social media platform. And that's your market update. Joining me now from London, Ontario is my colleague Hiran Amin from our direct investing educational team, and David Nelson, chief strategist with Belpointe Asset Management, joining us from Greenwich, Connecticut. Now, before we dive in, a reminder to our viewers that the views and forecasts expressed are solely those of David and his team at Belpointe, and they are based on their research. Now, David, what does it say about market psychology right now that we're seeing? We see credit concerns bubble up for an afternoon. The next day, we forget about it. We worry about regional banks in the U.S., and the next day, we have forgotten. We worry about valuation. You get the point what I'm talking about here. The market psychology right now. How does one get through a market like this?
You know, the market stayed resilient, maybe surprising a lot of long-term skeptics. And I'll put myself in that camp as well. You know, we're wired to worry. When things go badly, we complain, obviously. But when they go well, we still complain. We're always looking for, you know, the next shoe to drop. But the strength in the market has been undeniable. I'll admit that valuations are high. But when you look underneath the surface, what's really driving the rally here is based on fundamentals. And the cash flow and the earnings right now that we're seeing is pretty extraordinary.
All right, so we have something to hang our hat on in terms of fundamentals, and I prefer that in terms when you're trying to figure out what a market is worth, because so much of it comes down to macro, trying to guess what the Fed might be up to next. So they're signaling some caution. I mean, they didn't come out of the gates. The market was thinking December was going to be a done deal. Jay Powell changed their mind to a certain degree on that, and now as I was just going through the Challenger and Gray data, we're just trying to figure out where we're actually at in the U.S. economy. How much of this, too, is investors just waiting to see what we're going to get from the Fed?
You know, the Fed, the narrative changed. And I think what Jay Powell wanted to do at the last minute, he wanted to take back control of that narrative because the markets had priced in almost 100% probability of cuts throughout the rest of this year and even one in January. He wanted to take that back to say, hey, you know what, we're in control here. But clearly the path for rates is lower. I expect Fed funds probably to hit the terminal rate somewhere around 3% sometime next year. And I think the jobs data is softer than we we're led to believe. I was always a skeptic of the BLS data. I think it was flawed. Anything that's reliant on technology established more than 100 years ago of calling people up and doing surveys, it probably flawed there. There's a lot of real-time data out there, and some of it's concerning.
All right, David, let's hang on that for a bit, and let's just turn our direction to the fixed income space, looking at yields. Yields are moving. We got the repo market that's flashing signs of stress. So if you think of, as investors, how worried should we be about the cracks that are forming in the fixed income space, or bank liquidity, or let's call it that, versus just the market adjusting for higher for longer rate reality?
I hear you on that. As equity investors, we're focused on earnings, bubbles, geopolitical events around the world, but it's usually the real challenges come when something goes wrong with the financial plumbing. And there was some concern in the last couple of weeks. Apparently, at the end of October, the Fed injected about $30 billion into the system, and everybody was asking why. What did they see that we don't? I think bank reserves were probably on the lower level of normal, and it seemed that banks were going to the repo desk, and overnight funding seemed to have some cracks in it, and a lot of bond wonks, like I like to call them, noticed that. And if there's any challenge to liquidity, the first place it's going to show up is in high beta names, some of the most popular names out there, even the Apples, the Nvidias, all of those, they'll be for sale.
Okay, so let's talk about some of those equity names and valuation specifically. We just touched upon that a little bit. S&P is trading at close to 22.3 times forward earnings for next year in 2026. Tech's just around 30% or so. But what we have seen come up with these earnings, we've seen beats on both the top and bottom line coming on. A lot of that's being driven by these AI-led names. Now, could this momentum still carry on, or is this masking any broader risks in the market that we need to be aware of?
Well, there's good news and bad news here. The good news you just talked about. The earnings are there. We're looking at about 12% bottom line growth for the S&P 500 for this year and next year. The challenge is that stocks are going up faster than that, and if that's the case, then you're going to see, multiples are going to be challenged. You're going to see the multiples rise, and people will start to get concerned about valuations. I think what holds all this together is the fact that productivity appears to be rising. When I look at my spreadsheets, I'm looking at maybe operating margins for the S&P 500 are rising fairly substantially. There's no hard evidence yet that it's AI related, but it certainly seems that way. I know I'm using AI here. It's certainly making me more productive. It's almost like having 3 extra research analysts at my disposal. I have to believe productivity is rising across the board.
When you talk about those valuations, David, and obviously that starts making people nervous, and then they look to history, right? They're trying to figure out, have we been here before? Is there something that can guide us through the time? Then we go back to 1999, we go back to the dot-com bubble. I believe you're saying it's different this time, but there will, I assume, be some companies that will not survive it.
I don't want to use that phrase.
It's different this time, yeah.
Quite the same way, because I'll get beat up pretty badly on that. But the narrative that the AI trade is in a bubble, it's been deafening, and the very fact that so many people are calling it a bubble probably means that we're not, it's not there yet. And I get the comparisons back to the dot-com. I was there. I was managing money at Lehman Brothers during the dot-com, and I remember the double ordering. I remember the Y2K pull forward of demand. And dark fiber, that was a strong leading indicator that something was wrong, that a lot of that fiber networks went dark because the demand wasn't really there yet. To the best of my knowledge, there are no dark GPUs out there, data centers not being used. Our problem isn't the demand side. Our problem is, the one problem we do have right now is power. The one thing we know about AI is we're going to need power and a lot of it, and we may not have the power capacity to meet that demand.
So let's talk about, just go back to earnings for a second, David, and we'll kind of harp into that theme. So you mentioned, operating margins are expanding. We've seen, top and bottom line beats, but we've also seen the stock prices have run ahead a lot of these earnings, and then we haven't seen as much of a sort of a froth in the pricing. I think the average coming into this earnings is about 0.4%, stocks are, dropping. Even based on sort of decent numbers that are coming out of this. So when we think about, which sectors or factors do you see justifying these valuations? So that's one thing. And then second, what do investors need to be cautious about coming out of this earnings?
You're bringing up a really important point, and I'm going to put it in this context as market structure. It doesn't bother me that AI stocks are going up. I think the fundamentals justify that. What does bother me that is wide areas of the market are being ignored. Last week, the spread between consumer staples and technology stocks was minus 600 basis points, a full 6% in performance. It was almost like a capitulation that nothing else in the economy matters. And the last time I looked, we're still buying toothpaste. We're still going to the store. I pull up to the pumps. I buy gas. These stocks deserve a spot in a portfolio. And the fact that everything rushes to AI, that creates the crowding effect that you're talking about. As far as the run-up goes into some of these earnings reports, we pay a price for that. I've owned a couple of names where they've run up maybe 15% in days just before the earnings. And when they come out with a really good earnings report, but the fact that it wasn't a blowout beyond expectations, they go down 15%. That's the price we pay.
David, it feels like when you're talking about that, and we could perhaps see if investors start to realize these unloved parts of the market actually are, worth taking a look at, a healthy rotation where tech won't lead so much. I think what people are worried, though, is that any rotation that when it comes will not be healthy. It's going to be this big exit for the doors out of an AI trade into something else in sort of a market disruption. It feels like a market that's very jittery. You said off the top we're wired to worry about, what could undo all this. Can you see a scenario where we get a healthy rotation for a broader market rally, or will this sort of be a violent reorienting of how we're thinking about these markets?
Unfortunately, any rotation for the S&P 500 will be violent. Because if you rotate out of tech into some of these other unloved names, areas like energy, consumer staples, or even healthcare, if that happens, you're talking about people selling some 35% of the market to buy an area that's only 10% of the market. It's going to be a disruption. We're market cap weighted index, so the market would go down a lot. In that regard, I would like to see something a little more smoother. I don't mind that the technology rises, but we can't leave everything else behind. That creates that's how accidents happen. Is you get an event, and it wouldn't take much to trigger something like that.
All right, David, speaking of accidents, and let's see how we can minimize some of the effects of those accidents. You've got rate uncertainty, you've got the overhang of valuation risk, you've got the crowded trades. So where do you see compelling opportunities in the market going forward?
I think healthcare is pretty attractive. Unfortunately, if you look within the sector, you're going to see a lot of really big losers, but you're going to see some big winners as well. And they're really subject to headline risks. So much of it's controlled by Washington. Once we can get beyond some of the headline risk and Washington gets their act together, and then we open the government again and start to get back to work, within that sector, there's some pretty attractive names, especially within the drug area. They're going to benefit from the AI trade as well. Drug discovery is going to be a big part of what AI does. Even within consumer staples, we use these things. There's a price point where they're undeniable. We probably aren't there yet. And then the last area is probably energy, except energy is, of course, in transition. What I applaud the administration on is that this is an all of the above approach. And what I find really attractive right now is solar. And it seems counterintuitive to link this administration to solar, but I would say don't listen to what they say, watch what they do. And what they've been doing is really pushing hard for utility scale solar. So there's a lot of companies in that area that are going to benefit greatly.
David, fascinating conversation. I'm so glad you joined us today.
Thanks so much for having me.
That was David Nelson, Chief Strategist with Belpointe Asset Management. Just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only and should not be considered investment advice or buy, sell, or hold recommendations. Here, and what a great conversation with David. Lots of fascinating stuff. Really intrigued when we were talking about the fact that the criticism of the market, and this is not a new criticism, it's going on for years, that tech is leading the way, and without tech, what would we get? Then people say, well, I'd love to see a broadening of the rally then into other areas, but David said that probably wouldn't be a gentle affair with that much money moving out of the tech into other parts of the market.
Yeah, absolutely, Greg. You're correct in saying that. You got market cap weighted. It's all skewed to the tech side. So if we do see a bit of a rotation happening, it's going to be a very vigorous and violent one that we might see. But there's opportunities. I think there's spaces as we closed up in our interview. David mentioned healthcare space is exciting, especially with the collusion of AI and healthcare, and especially when it comes to drug discovery. It's such a laborious process to do the R&D. It's capital intensive, and we can see maybe some efficiencies being built out there, and then renewables and going to the energy space. That was a new one for me, Greg. I didn't know they're really exploring that, but there's opportunities, of course, in with solar technology and other things. We know with the AI that small modular and nuclear reactors is kind of the theme with what the utilities are satiating this power hungry data centers that are out there. So ones to keep an eye out on for sure.
Lots of great stuff in that chat. I think our audience would benefit. I'm going to bet if I'm going to go back and rewatch it again, even though I lived through it, just to pick through some more of the ideas from David. But if you at home have a question for our guest or team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the platform risk-free. Just open a practice account by clicking on Try TD Active Trader, that button right there. Then when you're ready to switch to a live account, simply export your workspace, start trading for Rio. Right now, it's time for a more technical take on what is happening in the markets here, and you're taking a closer look, and you mentioned it in our conversation with David, the 10-year bond yield.
Yeah. Let's peel back on that 10-year bond yield. It's one we haven't circled back in a while, but it has been making moves, Greg. Just a reminder for our audience that the 10-year Treasury note, we've got the ticker symbol TNX. It's basically the interest rate at which the U.S. government borrows money for about a decade period, right? It's the 10-year note. It also serves as a key benchmark interest rate for investor sentiment about economic conditions, but borrowing costs, more importantly, those mortgages is what it really is centered around there. So what's been making the moves, of course, this week? We had a couple of things. We know that the Fed is still, flying blind. There's a data drought that's happening, but there is still some private sector data coming. Greg, you mentioned at the top of the show, we had some revised numbers coming out this morning. ISM Services Index did move up. That came out Wednesday. But the bigger one was the ADP private role numbers that came out for October. And that did show an increase of about 42,000 that came in when the consensus was about 22,000. So quite a significant jump up. And this is a big reversal from September, which was at negative 29,000. So this will be all ingested, understanding that the labor market is not, on a jumping off a cliff, but it is moderately softening there. And again, and the last thing I'll mention is the Supreme Case Court that's going about the tariffs, right? And one note, one of the liberal judges on there, Justice Sonia Sotomayor, posed a statement to the General Counsel saying the tariffs are not, the tariffs are not taxes, but that's exactly what they are, and they're generating money from American citizens and it's revenue. And what this implication is, if the court does rule against it, the White House may be forced to return the money back collected on these levies. And what this will mean in terms of the bond yield itself, if the money is returned, it could send those treasuries higher and prices lower. We could see a sell-off here. But let's see what the price is unfolding here that we have so far. So we've seen from the start of this year, this long descending trend that's forming. So we've seen lower and lower yields coming down, which means prices are going up. This is all obviously in line with what we know, the economic uncertainty that's been marked by 2025. But coming into what we see today, Greg, I do see yields bottoming out just below the 4%. We did see this big collapse back on Liberation Day, breaking below the 4%, but it quickly retreated, pulled back up above this key support level of 4% or 400 basis points. But what I do see is this inverted head and shoulders pattern forming. Now remember, prices move inversely to yields. So as yields rise, prices are going to fall. But what it has been doing is respecting this upper sort of channel or this upper trend, which is acting as resistance. It bounced, it rejected off of this. I just made a note on this. We had this green yield tick up yesterday because on the ADP and ISM numbers, but we do have it see it's falling again today here. What I do see happening is it's continuing to kind of play range bound within this area before we wait for a breakout. It is forming this inverted head and shoulders pattern, which is kind of a bullish push, but it's got to break out of this pattern and then possibly test back. This previous resistance used to be support back here in the summertime, which is now acting as overhead resistance around that 4.1 to 4.2% yield. So we might see a little bit of sell-off on the bonds, especially if the earnings are robust and, you know, we still have very risk-on environment that we're going into the next quarter.
All right, definitely an important thing to watch, the 10-year U.S. bond yield as it tries to work its way through all of these different headlines about the U.S. economy. As promised off the top of the show, buy now, pay later. There is a stock for that, and you're taking a look at it.
I am, yeah. The stock we're going to take a look at is Affirm Incorporated. So AFRM is the ticker symbol. So they're one of the leading buy now, pay later solution providers. They'll be, in fact, reporting earnings today after the market close. Greg, this is akin to, I guess, back in the day, I've never partaken of it, but layaway plans.
Yeah, the layaway plan. Buy your fridge or your stove.
Layaway plans. It's the modern version of it, I guess you want to call it that. But Affirm's going to be reporting earnings today. They've seen a bit of an uptick happen. They're coming into profitability. 11 cents EPS is the expectation. It's going to mark a 27% year-over-year growth. Revenues coming in at about just shy of 885 million. That's again about 27% growth. But one of the bigger themes that's been playing out is a JD Power, research study they did this year showed that 42% of millennials and Gen Z consumers said they used BNPL services or buy now, pay later services, which is twice the rate that any other generation when you compare it there. So this is one to keep an eye out. But also coming into this, Affirm itself specifically has struck significant deals with a lot of the big players, with Apple, Amazon, Shopify, Costco. They now embedded with Stripe's payment systems to offer that right at the point of sale, in fact. And they've also struck up a partnership with Wayfair. Some of your bigger ticket items there. More merchants, more distribution is kind of their MO on this. They also have customer loyalty. That total transactions of 31.3 million in Q3 of 2025. And this was fueled by 94% of repeat transactions as part of this. So you can think about as we see more froth in the economy and if people are being more pinched, they're going to be adopting this. So this is a real sign or a barometer as well of how people are looking to spend that money. And if there's a bit of a liquidity crunch and they still want to go out and buy, they're going to be turning to these services here. But let's turn to the charts, Greg, and see what's been unfolding, because since April lows, we've saw this big sort of bullish channel that it started. We did hit this topping tail formation. I'm going to try and zoom in and just see if our audience can see this. It hit this new, it just kissed this new high of 100, rejected off of this, and we closed back within the channel here. But more significantly, coming out of September, we did see a big breakthrough this price. Whenever we want to see whether a trend is breaking, we want to see confirmation, and there's a couple things. We want to see at least 3 closes outside of that break, but also making new lower lows. And in this case, it did. We saw it break and made a new lower low, and then it had another lower low over here. So we started a new short-term downtrend. And what this has in fact done is it's formed this descending triangle pattern over here. Now coming into earnings, they have had a record of beating earnings here. So coming into this, I'm looking for an upside move of breaking out of this, potentially going to 80. But on the downside, you have the 65 level and potentially down at the $60 level, which marks the 50% Fibonacci retracement level there that we might see come out.
All right, so you've done all this great chart work. It seems that we should probably walk through a couple ways that we could trade Affirm holdings. Before you get started, though, I just want to remind our viewers that the options trading itself carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Take it away here and show us some strategies.
All right, let's start with a bullish play that you could play on for this trade here. So the trade that one could look at is what we call the Jade Lizard strategy. It's essentially, if you want to break it down, it's a risk-defined short strangle. Now, just to explain what a short strangle is, Greg, a short strangle typically means you're selling a call and you're selling a put. But the strangle itself poses a risk. Now, the Jade Lizard, what makes it different is we're capping our upside risk, and that's why I said it's risk defined. So what we're doing in this potential trade, if you're neutral to bullish, you may want to put it on, is we're looking to still sell a call and a put. So in this case, we're looking to sell the $80 call. So where I've kind of marked where there's a resistance level, the stock is expected to move around just around $10 there currently from where it is. And we want to cap it just in case we do have an outsized move. We don't want to be exposed. So we go ahead and buy a further out of the money call. In this case, I'm going to be choosing $85 as that strike. So we have a $5 wide credit call spread on one side. And then we have on the downside, we're selling a $70 put. Now, whenever you sell a put, Greg, remember, it's a way of also investors use this to acquire a stock. So if the stock happens to fall down and you're short a put, you could get a sign where you have to pick up the stock. So in this case, we see potentially if someone wants to use it as a play to pick up the stock at a valuable price, which is $70. But the key here is what makes a Jade Lizard is the total credit and it posing no upside risk. And I'll tell you why in a moment. So this trade overall is an income strategy trade. So I'm collecting premium for doing this. In this case, we're looking to collect $6 or $600 on a single contract. We're excluding commissions as part of our conversation today. But what this means is if the stock happens to move up to the upside, my spread is only worth $5. So this is what I meant, that there's no real upside risk, because if we collect $6 up front, and should the stock happen to go, which we don't want it to, we want it to stay within this kind of range between $80 to $70. But if should it go to the upside and go past 85, the spread would be worth $5. But we collected $6, so we have to end up buying it back, but we're still ahead by $100 at the end of the day. So there's no upside risk. But on the downside, I know this is where you want to ask, Greg.
We got assignment risk, it looks like, at plus.
We got assignment risk. So that's the one thing here is when you think about the income you collect, which is $6, you think of your break-even point. On the downside, the break-even poses at $64. So if the stock falls down to below 70 and goes down all the way to 64, that's when we start losing money. But we will get assignment risk because it happens to be in the money, and that means we could get the stock put to us and we have to pick up the stock at $70. But we might take heart from knowing that our net cost ends up being 64 if you can consider the income that we're generating. And then, of course, the max gain situation, of course, if it stays between the 70 and 80 in this earnings print, then we get to keep the full $600 that we collected, and we walk scot-free in and get some nice a nice dinner date with the missus.
There you go, off of the Jade Lizard. What other ideas you got for us?
All right, let's flip the script and let's do the other side. So if you expect downside movement, we talked about a lot of the stocks have been priced to perfection, prices being running ahead of these earnings. And that could be a similar story that could be playing out in this space as well. So one of the trades you could consider doing is what's known as a front ratio put spread. So we're looking for directionality in this one. It is a speculative trade in terms of we're expecting a move down. We are going to be paying for this trade. So what this is essentially is what makes the ratio is we're looking to buy the 70 put, which is kind of at the money at the moment. And we're looking to play the downside. Now, based on the maps, on the levels of my technical analysis, we looked at the retracements on the Fibonacci levels. This $60 really kind of marks that 50% or that golden ratio, which is the 61.8% level over here to the downside. So we want to sell about 2 contracts over here. Now, it is a 10 wide spread that we're looking to do. Now, the reason we want to sell 2 contracts because it's going to reduce the overall net cost that we have in this trade. So when you think about the overall cost on this trade, I think it's about $1.40 is what the spread would cost us. So what we need for it to happen is the break-even price. You can see I've marked it at $68.60 on the downside. So we need the stock to at least push down to $68.60 for this spread to start going in the money. We make the max amount of gain when it gets to the 60 and kind of puts a stop at its price and kind of bounces off of that level. If that happens, we stand to make $860, which is essentially the $10 minus what we're paying, $1.40, which works out to $860. But here's where it gets interesting. We've actually sold 2 contracts on the short side. So while one is capped, the other one is uncapped. So if it drops below 60, we still have exposure to 1 contract. And what that would mean is that if it continues to fall, we have a second break even at 51.40 where we'll wipe out this $860 gain that we made and we'll start incurring a loss. But you also have assignment risk as well as part of this. So that means on the downside, we could be put the stock at $60, but our net even, break even would be $51.40 given what we've already made, prior to that price run. So that's where we stand. Our sort of true loss happens only if the stock drops below 51.40. So that you can see why this trade is in terms of the risk reward ratio would be well balanced in terms of what we're collecting and what the risk is if we believe that the technical levels should hold up at the supportive prices.
All right, some interesting ideas there for our audience. I don't know if some people have seen our social media videos that you, me, and Jason did. I think we did one ages ago where we have the names of these trades, and they're trying to figure out, did it feel like a punk band or a rock band? To me, Jade Lizard sounds like a hair metal band that was this close to superstardom, and then grunge showed up in 1992 and just made them a relic of history. What is Jade Lizard? If you had to put an idea on Jade Lizard, beyond what it actually means.
If I had to put an idea on Jade Lizard, I'm more of a techno fan, Greg. You know that, like house music. So it would be like an album to one of one of those big DJs.
A guy like this is like, I'm Jade Lizard spinning
like you
tonight.
bump to the Jade Lizard. You could work it into some lyrics there. So that's where I'm going to put my money on.
I think two good ideas there for band names or for DJs. Well, that is the show for this week. As always, investors should perform their own due diligence before engaging in trading. Now, we don't have a show on Tuesday. It is Remembrance Day, of course, but then we'll be back on next Thursday. Our guest will be Fairlead Strategies Senior Technical Analyst Will Tamplin. Make sure you don't miss it, and thanks for watching this one.